Hello, this is Stacy Francis, President and CEO of Francis Financial. Today we're going to be talking about the second quarter review as well as the 2016 investment forecast. So hang on to your seats because we have a lot to go through, and I have to tell you it's been quite a quarter. Our agenda is we're going to be going through talking a little bit about Brexit, the ripples in the market. We're going to be talking about the market review, what happened, what to expect going forward, and our outlook. And then we'll talk a little bit about our role as financial planners. So let's talk more about Brexit. The UK votes to leave. Were you shocked? I will tell you, I was shocked. In fact, when I woke up that next morning, I was just chest-fallen and was definitely one of the more historic votes of this century. The majority of Britons felt that they were being held back essentially by the EU, saying that they imposed too many rules and that on businesses, and also they were funneling billions of pounds each year in membership fees, feeling like they were getting little in return. Another high priority was immigration. They wanted Britain to take back full control of its borders to reduce the number of people going there to live and also work. So what this means is that the Britons are leaving the European Union. And David Cameron announced intentions pretty quickly right after to step down as Prime Minister as he had threatened previously. And the newly appointed Prime Minister is now Theresa May. Just to give you a little levity to this, when I told my son, who's now 10, that essentially the UK has decided to leave the European Union, he looked at me with kind of a funny face. And he said, well, how can they leave? They're located there. So anyways, I just bring that up because, you know what, they can leave both economically and politically, but guess what? When you go to London, it's located in the same place. So how did most people react? Well, not so good. In fact, these are some of the magazines that you may have seen. Panic grips Downing Street. Be very, very afraid. We're on our way out. Many investors really got caught up in the media frenzy. And unfortunately, the markets did too. In fact, this is a volatility index focusing on the global equity market. And what we saw right after the vote, just remarkable volatility. These unexpected results of the Brexit vote resulted in a high spike in volatility, which, as I mentioned, is a measure of stress in the stock market. So we saw a big volatility strike. And what happened is essentially that the pound sterling plunged almost 10% to its lowest level in more than 3 decades against the dollar. In fact, at the low, it was £1 for $1.32 on the morning after the vote. What does that mean for you? Well, it means if you're traveling to London like I'm going to be doing in the next several weeks, it's good for us. All of a sudden, a travel to England is much less expensive. But for someone on the other side, well, just like my relatives who came here to visit a few weeks ago, they found New York very expensive. And we all know New York is expensive, but for them, it was more expensive than it ever has been. What happened in the other areas of the market? Well, the Dow Jones actually dropped in value by 2.5% right after the vote was released and markets opened. And then we saw the FTSE 100 dropping too, nearly a 9% drop as soon as the market opened to end the day with a loss of 3.2%. The FTSE 100 is actually a pretty important index, and you may or may not have heard of it. But essentially, it's an index comprised of the 100 largest companies that are listed on the London Stock Exchange. Now, what's interesting for you to note, though, is that the FTSE 100, the losses were actually less in that market than they were in other European markets. So overall, things definitely could have been worse. So how did this impact investors? Well, patience is bitter, but the fruit is sweet. I love that saying, and it really shows for those people who were patient investors. Emerging market stocks actually have had an unbelievable rebound since then. They hit their highest point that we've seen in 8 months. U.S. stock market has recovered and closed at new highs, and the FTSE 100 actually has closed at higher levels than before the Brexit vote. really interesting. So let's take a look at that. In fact, here's the S&P 500 in this beautiful recovery. It's gone up about 4.62% in the last month. Just beautiful, closing at a record of over 18,000. Then we saw the Dow Jones Industrial Average, again, a really nice one-month change, 4.87%, and again, beautiful at a record high of over 18,000. Then we have the FTSE 100, which as I mentioned, has the 100 largest stocks on the London Stock Exchange. It's at a new high, 6,682 points, again, is higher than it was before the Brexit vote. So we've talked a little bit about the market and the different indexes, but let's look at different asset classes. So here we're going to be talking about stocks as well as bonds. So what stocks, what bonds have done the best so far this year? In gray, it's showing you the year-to-date performance. In blue, it's showing you the performance just for the second quarter. And our starlight high performers, our rock stars of the year so far, have been emerging markets, pulling in a return of 8.6% so far year to date. Behind there, large company stocks at about 3.8%. And then the star performers of bonds, high yield bonds, about 9.3%, followed by investment grade bonds at about 5.5%. Of bonds, however, even though we have some nice returns, we're seeing overall that interest rates across the U.S. markets have been decreasing during the quarter. And you can see that the yield curve, which is the type of income someone can expect from a bond, people were receiving higher yields back in June 2015 than we actually are seeing right now. What does this mean? Well, essentially it's saying that individuals are having to take on more risk for higher returns. So what does that mean? And are you going to see these same heady, large returns in the future? Well, ultimately it depends on what stocks you own, because expensive valuations for stocks imply lower future returns. And here's an example. Over here on the left are stocks that trade at 10 times or less than its price to earnings. And we're seeing that over the next 5 years in blue and the next 10 years in gray, that we expect them to have pretty heady returns. So relatively inexpensive stocks are having returns of potentially 18% each year over the next 5 years, or 15% each year over the next 10 years. Now, if we move all the way over to the right here and looking at pretty darn expensive stocks, these are stocks that are trading more than 35 times their price to earnings ratio. And with that, you can see over the next 5 years, the returns are going to be negative. You're looking at even losing money. And over the next 10 years, you can see it's going to be flat. So this is something for you to understand, because the returns in the market are not even across the board. It also is dependent on, of course, the quality of the investment, but also it's the price of the investment. And the more expensive the valuation, the more expensive the stock, the lower returns you can really expect. Now, what about emerging markets? We've saw some great returns so far from U.S. stocks, but what's the future of emerging markets? Well, with this, we're going to look at GDP. And GDP is a measure of the growth of an economy. And here we can see compared developed economies like Europe, Canada, the U.S., versus developing economies, emerging markets such as Brazil, Russia, India, China. And it's very apparent that developed economies in gray here, like the U.S., have much lower growth rates than the growth rates that we're seeing in developed economies. Going forward, what is the future going to look like? Well, don't hold us to a bar of exactly this, but you can see while emerging market increases in GDP are slower, they still vastly outstrip the rate of growth in developed economies. So even in a slowing global world, most emerging market countries are still growing faster than the developed world. offering a fantastic investment opportunity. Remember how I talked a little bit how individuals are taking on more risk for lower return? Well, that's what we're seeing. Investors are taking on greater amounts of risk in exchange for lower potential returns. Going back from 1996 to more recently, we looked at the duration of bonds, which is essentially how long someone would be holding a bond, and its yield, or the income someone receives from a bond. And what's interesting is you can see that individuals are holding bonds for longer time periods here, almost a 6-year, and getting what? A smaller return. So that's where you need to think about bonds are important for your portfolio. They are the airbag to your portfolio. But you want to make sure that if you need growth from your portfolio, that you don't overinvest in them any more than you really need. Also because interest rates are expected to rise. We've had very low interest rates, as you can see here, for many years. And past 2016 into 17 and 18, we see a projection for rate hikes starting to occur in late 2016 and beyond. Trust me, this is going to have a big impact on your bond portfolio, because what do we know? We know that when interest rates go up, bond prices go down. And that's a fancy way of saying that you're going to potentially not earn as much as you would like to earn from your bonds. If you want to get really specific, let's actually take a look at a bear case, a base case, and a bull case, and what's expected from these different asset classes over the next 5 years. So here, let's talk about this base case. Base case is similar to the type of recovery that we're feeling and we're experiencing today. We're expecting a 4% return from U.S. stocks each year over the next 5 years. Not so exciting. REITs, Real Estate Investment Trust, expecting about a 2.9%. The other areas where there's not so much excitement, investment grade bonds. While they did very well this quarter and year to date, they are not expected to do as well going forward. In fact, a return of almost flat, 0.8%. And then Treasury inflation protected securities, those having actually potentially a negative return. So where is the bright spot? The bright spot essentially is Europe, expecting a 14.5% return each year over the next 5 years. Emerging markets, an 11.8%, almost a 12% return each year over the next 5 years. When it comes to bonds, the story is good there too. High yield bonds, 4.8%, and floating rate loans, 6.2%. But these have much more risk than just this regular investment grade bonds. So as I mentioned before, people are taking on more risk for higher returns. Well, this is a perfect scenario of that. The bear case, no one wants to see. No one wants to go deal with the bear case, and it's not something that actually has large probability. But the bull case is another area where we're excited potentially to see, but that too, unfortunately, has low probability. So what is our role as a financial planner or a wealth manager? Well, it's making sure the market's working for you. It's making sure that your money is invested smart, reducing taxes, that it's invested in the lowest cost possible, and that it's diversified, and that you stay disciplined. So let's talk more about one of the most important pieces that you can think about, and it's called behavioral finance. The only way to get beyond these mental errors is to set up rules, set up framework, and we call that an investment policy statement. An investment policy statement is essentially the 10 commandments for your portfolio, telling you the type of investments you should have, the mix of stocks and bonds, when you should change the mix of stocks and bonds, and what your ideal long-term outcomes are. And so here is an example of mental mistakes that occurred and happened to people who didn't have investment policy statements. And this one is the first one. I knew this stock was going to be going up. So somehow someone just had a gut reaction. Well, I'll tell you, gut reactions are not good predictors of investment success. Or I work in the industry, I know what's going on. I don't know how many of you remember Enron. Many of those executives felt like they understood the industry. They invested all of their life savings actually into their company stock, Enron, and they lost their shirt. They also lost their retirement. I've also heard I wasn't wrong about that stock, just unlucky. Well, I'll tell you, there's nothing lucky or unlucky about investing. And if you feel like investing is and your success is based on luck, then you definitely should not be doing it without an advisor to help you. In fact, the biggest mistake is overreacting. And here's an example of someone who hit a pothole and swerved their car afterwards, creating an even bigger accident. And we say that this is actually the same thing in the market, that reacting to a market drawdown, a downturn by moving to cash is like swerving your car after you hit a pothole. In fact, after you've hit a pothole, you already have the damage. It's not going to fix the damage. If anything, it can create a new accident or a new problem. So this is something that we also say it's a great analogy also to use for investing. The whole parachute thing, too. I don't know about you. When I was young and I was crazy, I jumped out of a plane. Well, you have to know how I studied numerous times which cord to pull, right? Which cord do you pull? Well, I have to tell you that having that information and understanding that is really important to know before you jump out the plane. Well, it's the same thing with being an investor, knowing are you a conservative investor or a more aggressive investor? Because just as jumping out of a plane and trying to figure out which cord to pull once you're in the air is too late, it's just the same being too late of trying to get more conservative with your portfolio and sell and go to cash when the market is in a decline. It's too late. It's too late. In fact, for those people who are able to deal with the fear and still buy stock, they actually are significantly further ahead. In fact, buying stocks when fear runs really high in the market has led to long-term gains. I'm just going to show you a couple of them here. I think is really interesting. Back August 31st, 1998, there was a one-day loss of almost 7%. There was concerns about Russia's economic crisis. We saw the one-year return after that, almost a 40% return. More recently, we saw a 6% loss. This was back in August 2011, and that one-year return from that date was a 28% return. It really pays to stay invested. In fact, those people who stayed invested in the S&P 500 from 1970 through 2015 had a return of a little over 10%. Those that missed the best 5 days, that went down to 9%. Those that missed the best 25 single days, it went down to 6%. Missing only a few days of strong return can have a drastically large impact and reduce your overall performance. In fact, investing after corrections is ideal if you can handle it and can stomach it. In fact, we went back through the corrections going all the way back to 1928. We looked at 10% as well as 20% corrections. We saw that after a 10% correction, 6 months after, the market had recovered 22.5%. After 12 months, the market had recovered over 24%. Pretty phenomenal. Now, after 20% correction, the recoveries were even more significant. 6 months after a 20% correction, we saw a result of 27% return growth. And after 12 months after that 20% correction, we saw returns of over 40%. It really pays to stay invested. And if you have money sitting on the sideline waiting for a downturn, and you being a long-term investor is a wonderful opportunity for you. Here is an example of, again, how markets reward discipline, that despite all of these crises going back over time, 1970 to present, you can see that the MSCI World Index continues to march forward and continues to march upwards. So what is our role? Well, it's to help you create that plan, that investment policy statement, to choose the best investments, to have them be low cost, so more money is in your pocket, to have them be tax efficient, to help you stick with the plan, both in good times and more importantly, in bad times. It helps you adjust the plan because your investments are going to change. In fact, monitoring and adjusting your plan can start off as a beautifully constructed portfolio of 40% bonds, 60% stocks. But over time, guess what? Market movements, investment shifts, we see that your portfolio is going to change. And this is an example of a portfolio moving now to 70% stocks and 30% bonds. What's important is to monitor that and to also make sure that you bring it back to that ideal asset allocation. Helping you buy low and selling high to move back to that proper mix of investments. Now, I know that it's not always easy. So when times get scary, I tell you, just remember that the longer you stay invested, the smaller a chance you have of losing money in the market over the long run. And one of my models of success, Warren Buffett, I'm going to use a quote from him. And he said, successful investing, it takes time, discipline, and patience. And no matter how great the talent or the effort, guess what? Some things just take time. And that is true of investing as well. If you have questions about your portfolio, reach out to us. The Wall Street Journal conducted a study, and in that study they interviewed investors, and 80% of them said that they would benefit or like to have a second opinion on their portfolio. And so we've done just that. We will create a personalized analysis of your current situation at no cost. It will help you ensure that you're on track for your goals. And one of three things can happen. One, you're completely on track and your advisor is doing a great job for you, and you have the peace of mind knowing that you're with the right person. Number two, it could be that there are some significant changes that could be made to your portfolio, but we're not necessarily the right firm for you. And number three, it could be that we are the right firm. The firms who get the most from working with Francis Financial are those that need investment consulting, but also value advanced planning. Knowing that how your portfolio is working for you is just as important as understanding if you're going to run out of money and if you have enough money till age 95. That the financial planning and your portfolio are married together and supporting one another. So please reach out to us. We love to give second opinions. It's a great way for us to meet new people, to see how people are invested, and also it's a great way for people to understand what our work is and if it's a good fit for them. You can reach me at stacy@francisfinancial.com, or you can reach me at the office, 212-374-9008. Thank you for your time. Have a great day, and know that we're always here if you have any questions.